You know, chances are you've got something from the J.M. Smucker Company sitting in your pantry right now. But behind those familiar jams and that Jif peanut butter, this classic American company is making a massive $5.6 billion bet that is set to completely reshape its future. So what is really going on here? Let's break it down.
It all really starts with this one question. What on earth could Jif peanut butter and Twinkies possibly have in common? Well, the answer to that actually reveals one of the biggest, most interesting strategic pivots happening in the entire food industry today.
Okay, so before we can really dig into the risk of this huge new bet, we first have to understand the rock-solid foundation that Smucker's is built on. And that brings us to part one, their powerful brand moat.
Now, this moat is built on some truly iconic brands, starting with their, believe it or not, incredible strength in coffee. With names like Folgers and the super fast-growing Café Bustelo, Smucker's controls more than a quarter of the entire U.S. at-home coffee market. I mean, that is a huge, cash-gushing business.
And that moat, it gets even wider when you look at peanut butter. The Jif brand alone, just Jif, commands a jaw-dropping 39% of the market. Now you add in their other brands, and Smucker's total share is almost half of all peanut butter sold in the country. Now, if you're an investor, that kind of market power is exactly what you love to see.
And of course, you can't forget the namesake brand itself. Smucker's holds a commanding 45% share of the fruit spreads market. So you see, these three categories, coffee, peanut butter, and spreads, they form this incredibly powerful and stable core for the business.
So how do they defend all this territory? Well, with this number, 95%. That's the percentage of U.S. grocery stores their products are in. That massive distribution network is like a giant wall, a barrier to entry that's just almost impossible for any competitor to get over. But here's the thing. In today's market, stability isn't always enough to get investors excited. Management knew they needed a new story, a growth story, to really get that stock price moving. And that brings us to part two, the big bet on snacks. Now, this didn't happen overnight. This was a very deliberate reshaping of their whole business. Over just a few years, they started selling off slower growth assets, things like Crisco oil and most of their pet food business, to really streamline. And then, in 2023, came the bombshell. They went out and acquired Hostess Brands. And let me tell you, this was no small deal. The price tag was a staggering $5.6 billion. This wasn't just, adding another brand to the portfolio. This was a transformative, high-stakes wager on the entire future of the snacking industry.
Of course, a bet that big, it always has consequences. To pay for this massive deal, they had to take on a mountain of debt. And that move completely changed their financial DNA, introducing a whole new level of risk that investors now have to grapple with.
So you might be asking, how does this debt actually impact me as a shareholder? Well, it's completely reshuffled the company's priorities. The number one goal now, bar none, is debt reduction. They're targeting paying down $500 million every single year, with a clear goal to get their debt levels back down to a more manageable level by fiscal 27. And the immediate result of that? Share buybacks, a key way companies return cash to investors, are totally off the table for now. All the focus is on fixing the balance sheet.
On top of all that, this big bet is happening at a really challenging time. The company is now navigating some serious issues, which brings us right to part three, headwinds and high stakes. First off, the consumer has completely changed. After years of high inflation, people's wallets are stretched thin. And look at this. Back in 2019, taste was the top priority for most people. Today, that has totally flipped. For nearly 80% of consumers, it is overwhelmingly about one thing: price. So at the exact same time their customers are pinching pennies, Smucker's own costs are going through the roof. Green coffee costs, for example, are at record highs. This puts them in a really tough spot, right? They're forced to raise prices on the very same customers who are more price sensitive than ever. It's a classic margin squeeze, and it's a direct hit to their bottom line. And then there's the big acquisition itself. This is a direct quote from Smucker's management, and it's brutally honest. They said, "We are not satisfied with the current results of the Hostess brand. For a $5.6 billion purchase, that is a deeply, deeply concerning thing to hear."
Now, to their credit, they do have a plan. They're focused on revitalizing the brand with new marketing, they're finding ways to run things more efficiently, and of course they're using that huge distribution network to get Twinkies and donuts into more stores. But the clock is ticking, and they need to show results.
Okay, so you have this stable, powerful core business, a massive and risky acquisition, and a really tough economic environment. How in the world does an investor make sense of all this? Let's try to bring it all together in Part 4, The Investor's Verdict.
I think it's really important to remember that even before this whole Hostess deal, Smucker already had two incredible growth engines running. Uncrustables, those frozen sandwiches, are on an absolute tear. They're on track to become a billion-dollar brand by 2026. And Café Bustelo coffee just continues to see fantastic growth. These are the bright spots, totally independent of the big snack bet that give investors a lot of hope.
And this all brings us to the core thesis for anyone looking at this stock today. Smucker's has become a classic show-me story. The market has heard all the promises about this big pivot to snacking, but now it's on management to prove, to show they can actually execute and create value from that massive Hostess bet.
So where does that leave the stock's valuation? Well, if you look at its forward price to earnings multiple, Smucker's is trading right in the middle of the pack compared to its peers like General Mills and Campbell's. What that tells us is the market isn't giving it a premium for its growth potential, but it's not punishing it with a steep discount either. It's basically pricing in all of this uncertainty.
But there is one key number that provides a really strong floor for the stock. The company has a projected free cash flow yield of 8.4%. In simple terms, that means for every dollar of the company's value, it's generating over 8 cents in pure cash profit after all its bills are paid. That is a very strong number, and it shows the core business is still a cash machine, which is exactly what they're going to need to pay down all that debt.
Which leaves us with the ultimate question every investor has to answer for themselves. Is J.M. Smucker successfully transforming itself from a legacy pantry staple company into a modern, exciting growth powerhouse? Or is it just a collection of classic brands that took on way too much debt at exactly the wrong time? The answer to that question will decide the fate of this American icon's $5.6 billion bet.